So there's been a lot of news around AT&T this week, and we added more. We're not worried about it. I know a lot of people sold off, and this is why it's so important to have your own conviction. I love doing due diligence, developing my own conviction, because in the tough times when there's negative sentiment around a company, if you've done your own due diligence and developed your own conviction, it will help you get through those tough times to keep holding unless the core reason for why you're buying has changed. Now, for us, when you buy a dividend, you're not just buying the dividend, you're buying the underlying company. So the dividend was a part of it, but I like to look at the big picture, look at the macro, and take everything into account, which is exactly what we did with the AT&T WarnerMedia spinoff. Hey, what's up? I'm Russ, and this is Dapper Dividends. So let's take a look at why we added more AT&T. We bought 5 shares at $28.99 the morning after the news broke and everybody was panic selling. We bought those in our Roth IRA, and I probably will add more across all of our other accounts. And because I have such conviction, we also bought 2 October 15th, 2021 $30 call options for $1 each. So those are obviously for 100 shares. So those cost $100 a piece. So why we added more? They're spinning off a non-core asset in WarnerMedia. It was less than 20% of revenue in Q1 of 21. So it's not a core asset. It's not a core part of their business. It's something that they bought. I believe it closed in 2018, so it's only been around for a few years. One thing I like is that they sold for a gain. They paid $85 billion in 2018, and they are receiving about $43 billion in aggregate cash plus a 71% stake in the new company. And about $60 billion is what that equates to. From this article, you can see that there's about $90 billion of enterprise value. So when you add those together, it's going to be over $100 billion. So they're not losing money on the deal like Verizon did when they sold Yahoo and AOL just recently, just before AT&T announced this. And they're taking about a $4 billion loss. I think the final number was $5 billion, and they had paid about $9 billion for the assets or so. Now the dividend is being cut, but it's being reduced because they're losing about 20% in revenue from the loss of WarnerMedia. That's a significant chunk, and it would be crazy, I think, for them to keep paying that because the situation changed. So they're minimizing the dividend. But the thing I'm keeping in mind and I'm keeping focused is that a 50% cut is still double the S&P 500 yield of 1.38%. People, I've seen a few different numbers, and it's looking like the dividend's going to be anywhere from the high 3% to anywhere as upwards of 5%, which even if we aggregate that and we put it around 4%, 4.5%, that still beats the S&P 500, and I'm still very comfortable with that dividend because this will allow AT&T to be focused on earnings and their revenue growth initiatives. Their current PE of 10 times earnings is half the S&P earnings of 22 times. So they have plenty of room for growth. They are going to be focused on paying down their balance sheet, their debt, and they're also potentially going to look at buying back shares. One thing I love is that AT&T is ubiquitous. If you're in the United States, next time take a look at how many AT&T stores or service vehicles or trucks, just their logo is everywhere. You're going to start seeing it more the more you look for it. And they're investing in 5G and broadband, which is pretty much back to their basics, back to their core business, back to their roots. This is also what Verizon is doing. 5G is the revolution. It's the future. And they are going to expand that into new markets. And they're expected to cover about 200 million customers in 2023. So I think there's plenty of growth for AT&T going forward. WarnerMedia is really looking to be number one in the space. They have announced that they're going to spend more than $20 billion on new content, which is the highest in the industry. Netflix is at about $17 billion. Disney, I think, was $12 billion or so. And new content is king. I've heard it with Disney Plus. It's great you get access to their whole library, but how many times can you watch Cars or Star Wars over and over again before you want new content? So I say new content is king, And WarnerMedia and Discovery, the new company, is going to be focused on that new content, dumping again about $20 billion into creating that new content. WarnerMedia / Discovery, Warner Discovery, I think people are speculating it's going to be called, is predicting about 200 to 300 million subscriptions, which was on an uptrend before the spinoff. And I think that they can hit those numbers if they're focused. Again, they want to be number one. They want to take on Netflix and Disney. And remember, this was acquired under Randall Stephenson. This was the kind of the old regime of AT&T at the head. This is new John Stankey. I like what he's doing, that he's moving on from WarnerMedia, something that is just not their core. And I think the company will do better off by itself. Both companies will do better off by itself. I think a lot of people kind of panic sold. They just heard dividend cut. A lot of people just buy the dividend, unfortunately. And you have to remember that you are buying the entire company. You're buying the underlying company and not just the dividend. If you added AT&T, or if you sold it, or if you're planning on buying, we'd really love to hear it. I would love to hear it. I'd like to know if you agree or disagree with my sentiments around the company. And follow me on Twitter at RustyRam78. We can check there. And if you have not checked out my video on Nintendo, my dividend stocks for kids, check that video out there, and I will talk to you in that video.